All right, it's 11:30, so we're gonna go ahead and get started. Thanks to everyone for joining our Tech Talk this month. This one is a fun one. We're excited to have Eder Casella Co CPA Kelly with us during this 30-minute conversation with Eric, CIO of Eder Casella Technology. They'll be talking about year-end technology purchases and how that could potentially impact your tax situation, what the purchases can do for your business, depreciation, and a lot more. So it'll be just an open conversation that we just get to sit in on. But should you have any questions throughout of the basically about your situation or want some more clarification, put those in the chat and I will be sure to watch that and then we'll have them answer at the end. But with that, I will turn it over to Kelly and Eric.
Perfect, thank you. So everyone, Eric Vicencio with Eder Casella Technology. I'm the CIO here, and I'm joined by Kelly. My background, I've been CIO here for basically since I started. We're been around 5 years officially, unofficially a little bit longer. And there's a phenomenon that I noticed, and I wanted to bring in a tax professional because I don't know everything about the tax side, even though I work for, partially an accounting company. So I brought in Kelly. So Kelly.
Good morning, everyone. I've been with Eder Casella for 15 years. I'm currently a senior manager and I work strictly with tax.
Perfect. So the phenomenon that I usually always see, and I wanted to pick your brain on this, is at the end of the year, usually starting about now, right, going into the holiday season, I usually see a ton of purchases from, the businesses that we support and take care of. And, in my mind, I'm like, okay, they have leftover money that they're trying to spend, but it also could be something else. So I wanted to talk about what benefits do purchases actually have for a business?
So any expenses are going to reduce the income of the entity. But what we would always suggest is you don't want to buy something just to buy it. You don't want to buy something if you don't need it. A lot of times what we'll say is, look a year ahead. If there's something that you're going to buy in January or February, but this year's income is maybe more than what you anticipate the next year is going to be, maybe right now is a better time to buy that and get the deduction to offset some of that income. So it all depends on the timing and what is actually needed within the company.
Okay. So I always hear about these fancy accounting terms. Gotta love them because those of you that know, I'm also married to a CPA, so I'm always like, okay, assets, liabilities. How does like a piece of equipment, how does that, it's depreciating, correct? So
Correct.
How does that work?
Yes. So the first thing you have to do is decide if you actually have a capital asset. So capital assets would be depreciated. So that would be something that would have more than 1 year useful life.
Okay.
And then something that kind of falls above the threshold of the capitalization policy within the company. A lot of times we see businesses follow the safe harbor for the IRS, which is $2,500. So that just is an election that gets filed with the tax return. So anything that's over the $2,500, we have clients take a deeper look into those items to see if they're maybe capital. And at that point, we would move them to the balance sheet. And so depreciation, like you were asking, is pretty much spreading out the cost over its useful life. So let's say it's a piece of equipment and you purchase it for $5,000. In simple terms, if they were using straight line depreciation, which, getting into the types of depreciation, we're not really going to get into that in this 30-minute conversation, but it would be a 5-year asset. If it's $5,000, you're going to expense $1,000 each year. So you're breaking it up into chunks and getting that benefit over that 5 years.
Okay. So most of the servers and things like that we sell to customers, so they would be anywhere from $5,000 to $10,000. So what you're saying in layman's terms as well is basically I would take a chunk of that each year and not take it all the first year.
Correct.
Okay.
Yes.
So could they take it just all in the first year if they wanted to? Okay.
So there's a couple of different things. In 2017, there was the Tax Cut and Jobs Act. So with that came the 100% bonus depreciation. But 2022 is actually the last year that the 100% depreciation will be in effect. It goes through 2026, but it is decreased 20% per year. So by 2026, it's only going to be a 20% bonus on that. So, but for 2022, it's still 100%. So equipment, there are certain things that qualify for it. So, you'll have to talk to your accountant to determine if what you're thinking of buying will actually qualify for this 100% bonus depreciation. But you are correct. So 100% of the cost would then be expensed in the current year. So a server for $10,000, it's equipment, you would be able to not only capitalize it, but also take that whole expense, that $10,000 in the current year. There's also another section 179, which you're also able to take 100% bonus depreciation, but there's other specific rules within that. So after this 100% bonus depreciation kind of fades away, there's still the section 179 that is available. And so we take that into consideration when we're doing the tax return.
Sweet. Okay, so let's say I'm a business, and I get this question a lot, believe it or not. And they ask me, okay, I'm going to buy this piece of equipment, but I'm not fully going to use it for work. I'm also going to use it at home. Can I still depreciate that, or is that kind of do I have to allocate certain portions of it?
You would just allocate. So you'd have to make an estimate based on how much you feel you'll be using it for business versus how much you feel you'll be using it personally. And so that's then recorded on the financials accordingly and depreciated at that.
But does anybody ever actually do that? No, never mind. Don't answer that question. Okay, so what about like software purchases? Would those also be included with this? Because in some scenarios, software is never truly sold. It's leased in a way. Is that something that could be included?
It depends. So it depends on the software. If you are going to the store and buying the software off the shelf, that would be something that you would put as a capital asset and depreciate. There's other situations such as online QuickBooks. That's a subscription that you don't have, you don't have access, you don't have control of making adjustments or personalizing that at all. So that would be more of a service fee. Okay. So that would be expensed right away. But if they call it a off the shelf kind of software, something that you just go to the store, you literally take it off the shelf and you buy it. That would be something that could be a capital asset. Again, if it's over your threshold, a lot of these things might not be over the $2,500, for example. So that wouldn't necessarily automatically be a capital asset, but it potentially could be.
Yeah, and I think that comes in really important in my realm quite a bit too, because there's a lot of people that are trying to go to these cloud hosted applications, cloud hosted everything, and that I think that really kind of messes with if they're trying to drive down their total expenditure, business expenditure for the year. So if we're doing something like this, let's say I have a customer that buys a server or a switch that's over the 2,500, let's say about 5,000, but then the install time, like my hourly charge to actually put that in, would that go into that total amount for depreciation, or would that just be taken that first year?
So anything to get that asset into service will be included in the price of the asset. So installation, freight, sales tax would all be included in the price. Okay. That would then be depreciated.
Awesome. Now, I always hear these fun stories about different types of companies, whether they're like an LLC or I think there's one called an S Corp or a C Corp, maybe. I'm just going to start throwing random letters out here pretty soon, like maybe an N Corp. No, I really don't. This is beyond me. I hear these terms, I can regurgitate them. Does that matter to a company and whether or not they can take depreciation or take it onto their books the first year? Things like that?
No, the type of entity really won't matter as far as the ability to take depreciation. A lot of different things will come into play when you are a different type of entity, but depreciation should be pretty similar across the board.
Okay, that's really good to know. So the other thing, working with other small business owners, especially startups, individuals that are maybe struggling to make a profit, is there any sort of thing tax-wise that they need to be aware of if they're taking potentially a loss multiple years? Because I know that was something that was brought to me by a good friend starting a small business and needed to buy a bunch of hardware, but they needed to show a profit this year. That's what they relayed to me. And I was just curious on what that actually means and why.
So the IRS has what they call these hobby loss rules. They look at an entity and they are looking for a profit motive. So they would consider a profit motive if an entity had income 3 out of any 5-year period. So that's kind of what they're looking at. The downside is, to become either a hobby or be shown as a business, a hobby, you're not able to deduct any of your expenses. So that's the real kicker. If the IRS were to come back to you and say, this is not a business, you have no profit motive here, you're doing this for fun, they'll go back to your books and see what your expenses are, and they could disallow those. So it could potentially be an issue if you continuously show a loss.
Yeah, that'd be like if a company set up another company just to buy all their equipment through it, always show. Okay, got it. Okay. Yeah, don't do that.
Don't do
that. Okay, so I'm getting hyper focused on technology, like buying new, laptops, computers, phones. Is there any other strategies that these business owners, small or big business owners, can use to actually help reduce some of those tax liabilities? Are there other things outside of technology that they can purchase or contribute to?
Now, it all depends on going back to the type of entity. Okay. There's different things that different types of entities can do. A lot of things, could revolve around retirement plans and contributing to those, setting up health insurance or health savings accounts. Depending on if you have employees or if you're self-employed, there's self-employed health insurance deduction that you could be taken advantage of. But again, it all depends on how the entity is set up, if they have employees and how large they are. So lots of different things that could affect the answer to that question. And okay. In our 30 minutes, I don't think we're going to get there.
Well, yeah, I was like, okay, I might be asking a loaded question. How about on from a individual standpoint? So let's say I'm not a business owner and I'm wanting to purchase a bunch of IT equipment or reduce my tax liabilities or taxes in general. Is that a thing? Is that a possibility?
No, sorry. No. Just an individual, yeah, your cell phones, computers, none of that would be deductible in any way. Sorry. Yeah.
No, it's okay.
We get that question actually a lot.
Yeah, I'm sure you guys get all kinds of fun questions.
Yes, we do.
All right. So what other things might, these potential customers or people out there that are watching, is there anything that we missed on reducing tax liabilities that you'd want them to know before getting ready to file this year's tax returns?
Yeah. I think it's important to have that relationship with your accountant, potentially year-end planning with them if you have financials that you could provide to review to see again, if you're having a really good year this year, what can you bump into 2022? And if maybe you're anticipating your revenues to not be so good in later years. Really the big thing is if there's equipment, that would be the main thing that you can kind of move around within years. But there could be additional things to discuss, but it is kind of a case-by-case basis, and you would have to talk to your accountant to see if there's anything new that could potentially help them.
Yeah, because I imagine that these rules change pretty frequently, don't they?
They do, and sometimes they don't change until the end of the year or after the end of the year, so it makes it a little bit difficult.
Awesome,
Yeah.
absolutely awesome. Yeah, so I've been seeing an interesting trend in a lot of equipment too, where there's not new equipment, new types coming out. If you've done any holiday shopping or have kids, you'll probably see that there's no new and exciting tech that's coming out this year. So what a lot of the companies are doing is they're actually offering discounts. So it's something that if you are a small business owner or even a mid-sized business owner, and you haven't shopped around for any equipment that's coming out or that you need to replace, right now is actually the time to do it before the holiday rush really hits, and then the end of the year, because there is some time limitations there. So perfect. Yeah, I think at this point, I think you've answered all my questions, certainly, because it's I don't know what I don't know, and I like to bring on professionals to kind of tell me what I don't know about these things, that I sometimes can speak the language just a little bit, but not fully really understand it. So, all right, do we have any questions out there?
Well, thank you both, first of all. But yes, we did have one question. I thought you were actually going to start to answer it there, but we didn't quite do it. If you purchase the equipment in 2022, but it doesn't actually arrive because of the supply chain issues, now, can you still count that towards next year? So say you purchase it in 2022, but it doesn't arrive until February 2023.
So per the IRS, the asset actually needs to be placed in service for it to be deducted. So the answer would be no, unfortunately.
Gotta love the IRS.
Yes, yes.
I guess that's a surprising answer. So I'm glad that they asked that. So, but yes, that was all that I see in here. So I guess we can go ahead and wrap this up. But thank you so much, Kelly, for joining us this month. It was super helpful. Always nice to have another face besides Eric's. We appreciate you too. But and thank you all for joining, and we will have our next one in the new year. So everyone have a great holiday. All right. Thanks, everyone.
Happy holidays.
Thanks.